Less than 2 weeks ago, the United States and Japan launched a historic intervention to rescue the yen, with Japan estimated to have spent roughly $87 billion across 2 days. But the yen is already heading back toward 160 because some traders aren't afraid of another intervention. They're waiting for it. Every time Japan forces the yen higher, carry traders get a better price to sell it again. And if Tokyo eventually has to break that cycle with higher interest rates, the consequences could spread from the yen into stocks, bonds, and credit markets around the world. That's what makes this much bigger than another currency intervention. Japan may have accidentally turned its own rescue operation into a recurring opportunity for the investors betting against it. The logic is brutally simple. Borrow cheaply in Japan and deploy the money into markets offering higher returns. As long as Japanese rates remain low and the yen remains weak, the incentive survives regardless of how much Tokyo dislikes it. So when intervention suddenly sends the yen higher, traders don't necessarily see a permanent change in direction. If the interest rate gap hasn't changed, they can see a cheaper opportunity to rebuild the same position. And that's already happening. Bloomberg reported investors buying dollar-yen again around 157 following the intervention. With the yen subsequently weakening back toward 160, those traders are effectively betting that Tokyo can move the market temporarily, but cannot change the economics underneath it. Now consider what Japan spent to create that temporary move. Bloomberg estimates roughly $53 billion was deployed during one intervention and another $34 billion the following day, around $87 billion across just 2 days. Less than 2 weeks later, the yen had already erased roughly half of those intervention-driven gains. That's the first warning that this isn't simply a battle over how much money Japan is willing to spend. It's becoming a battle over credibility. If traders increasingly believe every intervention-driven rally will eventually reverse, Tokyo's biggest weapon starts behaving differently. Instead of frightening investors away, intervention can create the price level they're waiting for. That produces a dangerous feedback loop. Japan pushes the yen higher, investors rebuild carry positions at better levels, and those positions put renewed pressure on the currency. Eventually, Tokyo has to intervene again, creating another rally and potentially another opportunity to reload. But the most revealing part of this story isn't what hedge funds are doing. It's what Japanese investors themselves did after their own government strengthened the currency. Japanese investors bought the most foreign assets in more than 2 years during the week following the intervention. In other words, the stronger yen created by government intervention made overseas assets more attractive to Japanese capital at exactly the moment Tokyo was trying to defend its currency. That's the contradiction at the heart of the problem. Japan is spending billions trying to strengthen the yen, while the incentives inside its own financial system continue encouraging money to move abroad. And this is where the story becomes important for investors who couldn't care less about trading dollar-yen. The money borrowed through carry trades doesn't sit inside a Japanese bank account. It gets deployed into higher returning currencies, bonds, credit, and other assets around the world. Bloomberg reports that real money investors remain positioned to sell yen against currencies, including the Australian dollar, euro, US dollar, Canadian dollar, and pound. Yen-funded positions against some higher-yielding currencies have already generated returns above 10% this year. The longer those trades work, the more confidence they can create. And the more confident investors become, the more dangerous it becomes if the conditions supporting those trades suddenly reverse. That's the risk Tokyo is ultimately creating for itself. Japan has 3 broad choices: keep spending reserves to defend the yen, tolerate continued weakness, or raise interest rates enough to make borrowing yen substantially less attractive. The first hasn't produced a lasting reversal. The second carries economic and political costs. And the third could affect markets far beyond Japan. Now, imagine the third option colliding with a change in the United States. The Bank of Japan accelerates rate hikes at the same time U.S. yields begin falling, rapidly compressing the interest rate advantage that made yen funding attractive in the first place. Then another coordinated intervention hits. The yen starts rising precisely as the return from borrowing, it starts disappearing. Suddenly, investors who were comfortable holding leveraged positions funded in yen have 2 reasons to get out at the same time. That's when carry stops being a source of easy returns and becomes a source of forced selling. Investors close positions in the assets they bought and purchase yen to repay the money they borrowed. Those yen purchases push the currency even higher, which increases the pressure on the next leveraged investor to exit. What begins as a currency move can therefore become a self-reinforcing liquidation across completely different markets. And that's the real contradiction traders may be underestimating. Every successful attempt to fade Japanese intervention makes the strategy look safer. That encourages investors to rebuild positions, potentially making the eventual unwind larger if Japan finally changes the economics of the trade. So don't obsess over whether Tokyo's next line in the sand is exactly 160 or 162. The dangerous moment is when US yields start falling while the Bank of Japan is moving in the opposite direction. If that rate gap compresses while the yen starts strengthening and popular carry pairs begin reversing together, the market will be telling us something important. The trade isn't simply becoming less profitable. Investors may be starting to unwind it. Until then, traders have discovered an extraordinary strategy. Let Japan spend billions pushing the yen higher, then use that stronger yen to rebuild the trade at a better price. That can continue as long as the market believes Tokyo won't fundamentally change the equation. But the more successful that strategy becomes, the more important the eventual reversal becomes for everyone else. In our previous video, we explained why the United States took the extraordinary step of joining Japan in defending the yen, and why Washington cares about Japanese capital and the US Treasury market. If you haven't seen it, watch that video next because it explains the first half of this developing story. And subscribe to Global Notes by JP if you want to follow what happens next, because the real question is no longer whether Japan can push the yen higher for a few days. It's what happens to global markets if Japan finally makes the world's most famous cheap money trade stop working.